Good morning, good afternoon, good evening, wherever this may find you around the world today. I know we have many people around the world who take in this webinar, some of them live and some of them on demand. Glad to have you with us today as we talk about this crop report. And frankly, there were not a lot of changes in this crop report. I will talk about those changes, but it also gives us an opportunity to talk about a number of other factors at play in the marketplace, including the U.S. election. And I'll be spending some time talking about what I see as impacts of the election on the grain and oilseed markets as we go forward. So now, as we look at this, price is still a function of supply and demand, but is modified by the flow of money. So we're going to start off with looking at the broader economy. We do not yet have the October inflation data. That will be released soon, I believe, next week. So the latest that we have available is September data, where we saw the headline inflation number drop to 2.4%, with the core actually ticking higher now to 3.3%. And so the Federal Reserve met yesterday, actually the previous 2 days, and decided to go ahead and nothing changed. It said the election doesn't change anything. We had a very bad jobs report on the 1st of November, just 12,000 jobs created. Some of that was due to the 2 major hurricanes that had hit the Southeast, disrupting the job market. But there were some other troublesome things in there as well. The previous 2 months prior to the hurricane were adjusted downward by 120,000 numbers. In fact, I think August job creation number was cut roughly in half. So there are some problems. Many of those are in the manufacturing sector. We've received quite a bit of data over the last couple of weeks showing that the service sector is really hot right now and growing strong. Manufacturing sector is hurting. Now, we've also seen industry surveys that have shown that many firms were simply waiting for the elections to make decisions on hiring and expansion. So I'm really anxious to see what the jobs report looks like the next couple months. Obviously, hurricane recovery is going to impact. If you're a business that was wiped away, that you're not going to recover very quickly. But for other businesses, see if it recover. But how many firms now start expanding and hiring people based on the expectation that a Trump administration is going to mean tax cuts or keeping the current tax cuts, not letting them expire next year, as was going to be the case under the Harris administration, and deregulation in a more favorable business environment. And so that's what I'm going to be anxious to follow here over the next few months to see if we see some changes for all of that. We also saw some consumer report data showing a pop in consumer sentiment, consumer confidence ahead of the elections. And that means increased spending. In fact, some of the data showed that we have seen increased consumer spending as that confidence is going up. So you have to be very careful about getting aggressive in cutting interest rates in that environment. So the Fed decided to just stay the course for this meeting and then assess things next time. But that's where we're at right now as we look at overall the inflation picture. But the Fed is focused on jobs. And for some reason, they've put 4.3% as their cap. We can't let it go over that, and they'll stimulate if we do. I'm not sure that's very wise right now, particularly in historically the normal inflation rate was at least a point to a point and a half above that. Now, as we look at where the inflation was on the left, we see the month-on-month changes. The big increases were in apparel and airline fares, but also fruits, vegetables, motor vehicle insurance. That's been a big one overall. Meats, protein sector, medical care services, et cetera. And you see how offset that was by major declines at the bottom of that graphic due to fuel and oil. If we look down here, dropping 4.2% roughly and 5% respectively. Now, year on year, motor vehicle insurance has been a big cause of service sector inflation, and the Fed has very little impact on that. That's largely a policy issue in many states not prosecuting car thefts or having cashless bail programs. and that's raising insurance costs for all of us. And that's been a major inflation problem. Tobacco and smoking products, another big one. Motor vehicle maintenance and repairs going up. Uh, Rent and primary residences has been strong. And I think that's going to be staying strong here as consumer confidence goes up. Perhaps rents coming down, but home ownership, home prices going up. Now, that has been largely countered by energy prices. What happens if those energy prices start going back up? Anyway, let's just keep that. I'm not predicting that right now on the energy prices, but let's move forward. Monetary base. And I've talked to you before how we're trending higher, even though the Fed is shrinking the balance sheet. And that's largely due to fiscal stimulus that we see in the economy that's keeping that money supply in the economy sufficient to support economic activity. Stronger in the services sector, weaker in manufacturing. Manufacturing, though, waiting to see who would win the election with a Trump victory, more business-friendly environment. Will that make a difference going forward? That's going to be one of the things we're going to have to watch. As we look at GDP growth, the third quarter, 2.8%, fairly healthy economy. Is it as robust as we'd like? No, but neither is it recessionary by any means. Recession, here we see the 2% or the 0% level. We drop below that for 2 quarters. That's a recession by definition. Unemployment rate of 4.1% now for the second month in a row. That's historically low. If we look at layoffs, at historically low levels, employers hanging on to employees. And in fact, they've been mentioning in industry surveys that as attrition removes employees from the ranks, whether it be due to retirement or whatever, they're having trouble finding replacements for employees to fill those vacancies. And so wage growth is starting to creep higher once again. Wage inflation. Now, unemployment rate has been overall trending, even though I showed you the last few months trending lower, essentially, but had been trending higher in the longer term picture because we're seeing a strong push toward immigration into the country and a very rapid pace of processing immigrants. And so that's increasing the workforce. Immigration is up 5.6 million people since the pandemic. And so as you increase the number of workers available, without changing the number of jobs available, you're going to increase the unemployment percentage. Now we look at household balance sheets. How healthy are they? Well, they're pretty strong right now in the United States and in Australia. When you look at Canada, though, in Australia, much weaker relative to us. So as we look at the percent of household balance sheets that are in excellent shape overall here, pretty good shape overall. Now, let's look at bankruptcy filings. There had been in 2023 a lot of stories about how bankruptcy filings were on the way up, but now the trend is back down once again, indicating some health there in that sector. Credit card debt. I remember seeing, of course, stimulus checks. A lot of credit cards got paid off here with stimulus checks. And then there was a lot of stories how we were increasing credit card debt. That is really flattened out right now and actually taken a slight turn down. If we look at corporate profits, they're near all-time highs. So relatively healthy economy. There are problem areas. I mentioned the manufacturing sector is certainly one of those. The housing sector has been one, although I do see some signs of optimism in the housing numbers of late. The share of Russell 2000 companies with negative earnings, this is one of the areas where we are seeing some problems starting to show up. Now, switch pages a little bit, our national debt. I went to update this page for this, and they'd done something with their website because they got some big announcement coming up that made it difficult for me to get a screenshot with the pictures I want. But really, we're on the cusp now of $36 trillion in national debt. And so if we look at interest paid on debt on an annual basis, this graphic here shows it's $974 billion per year, which is bad enough. But the Treasury Department has confirmed that that number in reality is now topped $1 trillion. And so to update these numbers a little bit, if you add up what we spend annually on Medicare, Medicaid, Social Security, defense, and interest on the debt, it comes to over $5.2 trillion with updated numbers. And what we are expected to take in this year in federal tax revenue is just a little over $5 trillion. So we haven't even paid for farm programs, for food stamp programs, for education, and all the other discretionary spending programs that we depend on our federal government for, and we're already at a deficit. And so one of the things I want to come back to is the fact that in June of 2023, President Biden came to an agreement with Congress at the time to suspend the debt limit. That's what's allowed it to grow up to this level. Suspend it up until January 1, 2025. That's less than 2 months away. So Congress certainly wasn't going to deal with that before the election, but they have to deal with it before January 1st. So we have a lame duck president and a lame duck Congress going to be making decisions on our debt ceiling. How they handle that is going to be watched by the credit rating agencies. And the credit rating agencies have indicated concerns over the political inability to deal with the debt crisis. So we do run some risk at this point of seeing a drop in our credit rating, which means higher interest rates. I fully anticipate that with a lame duck president, lame duck Congress, they're going to kick the can down the road and extend the suspension of the debt ceiling a period of time. I don't know what that period of time is going to be, whether it's going to be 90 days or 9 years. I don't know. But I do expect them to kick the can down the road. The bigger question is going to be, how will that be interpreted in the process of reaching that agreement be interpreted by the credit rating agencies? And that's going to be one of the keys going forward relative to interest rates. Now, we have seen this week Treasury yields drop dramatically. We saw about a 40 basis point swing up and then back down over the last few weeks. The longer term trend for those mid and longer term Treasury yields is still higher. And this is one of the big reasons, I believe, for that. If we look at discretionary government spending as a percent of the total budget, it continues to go down because mandatory spending, that includes the things that I outlined previously, is going up. And that gives Congress less room to work to try to fix our budget problems. And the longer they put this off, the less room they're going to have to operate to fix it. And that is a concern of mine. And when you look at our comparison with other countries, we have the largest primary budget deficit as a percent of GDP. And you can see here next to us is Japan, followed by France, which is quite a bit smaller than us. So that's a real problem going forward as far as US being able to stay competitive. Now, this is not related, but I did want to throw it in here as a point of interest. When I see slides of interest, right now we know that the stock market's being held up by, held up may be the wrong term to use, has been supported by this belief that artificial intelligence is really going to push us forward. And so you have these data centers being built to handle all the artificial intelligence needs. Those data centers that are being built require a tremendous amount of energy, electricity. And so if you look at what's currently in the plans, you have to add to the power grid in the next 6 years, by 2030, the equivalent of 3 New York cities. Add that to the power grid. And that's what this graphic is showing here. That's a tremendous boost to our power grid. And I haven't even talked about increased requirements of the power grid for electric vehicles. That's going to be one of the big challenges going forward to continue to move forward for artificial intelligence as well as EVs. Now, I think the EVs are going to face a setback. I don't think President-elect Trump, however you want to call it, I don't think he's going to put a stop to EVs, but I think he's going to move it toward being more market-driven versus government-driven than what we've seen in the previous administration. And there are implications for that for the liquid biofuels, and I'll get to that. Now, let's tie all this together with commodities. I'm not going to spend a lot of time in here covering what I've covered before, but again, the dark blue line is our StoneX commodity tracker, 27 different commodities in a basket covering the different sectors. And the correlation over 10 years is 0.86. Anything above a 0.7 is statistically significant. So that's a pretty solid 10-year correlation there. And you can see on the right-hand side how it's trending higher. So we have correspondingly have seen a rise in commodity prices. Much of that has been to short covering, not necessarily building length in the markets. Now, where do we go from here? I also took a look at the 2-year break-even inflation rate. We're seeing a stronger move there, a much stronger move in the 2-year inflation rate, almost 100 basis points here over the past month and a half or so, shall we say, almost 2 months. So that's pretty significant on expectations for inflation. The correlation is still significant at 0.82, as you see there at the bottom, but not quite as strong, but still pretty significant. So what does that mean for commodity prices going forward? Historically, if we see those inflation expectations continue to trend higher, we would see the funds typically in the past want to build ownership of the commodities. Not necessarily every commodity, but that does impact the price level at which they manage supply and demand of the commodities. So that's one of the things that we are watching. If you look at the correlation between the StoneX commodity tracker and the CPI, Consumer Price Index, the correlation is at 0.85. The divergence has been here of late where commodities have been chopping sideways to slightly higher while inflation continues to go down. Now, this is the broader commodity sector. Not every sector, not every portion of the commodities have been doing this. So I'm going to now break it down by sector of commodities and see what's happening. If we look at grain and oilseeds, correlation of 0.88. Much stronger correlation than what I would have anticipated there. And this is a 10-year correlation with inflation. Let's look at livestock. Much weaker, 0.56. Why? Because we have a shortage of protein right now. And so that has kept livestock prices overall strong, even as inflation's come down. That's been a challenge for inflation to come down with food prices continuing to trend higher. But the livestock portion of it has been breaking away from this correlation and continuing to trend higher because the tightness of protein supplies. Energy, again, 0.88 correlation, that's very strong. That should be no surprise. Not only does energy affect what we pay for the price of gas at the local grocery store or the price of diesel fuel to run the truck that makes the deliveries, but our fossil fuels also go into the production of packaging. Everything we touch, it seems like petroleum is involved in some way. So as energy prices go up, it tends to increase our inflationary pressures. As energy prices come down, it tends to bring inflation down. And that's what we've been experiencing. If we look at softs, the softs, this is similar to the protein sector. And the big driver here, I think, is cocoa, where we do have some significant supply problems that are continuing to keep cocoa prices high. When we look at precious metals, that's another place where we're seeing a real divergence, particularly with gold hitting all-time record highs. Correlation of 0.48 as a result. And the base metals, correlation of 0.81. That's more significant again, and that's related to what's happening in our economy, those base metals being an integral part of our economy. Now, let's come back to the food sector, grain and oilseeds and livestock. We saw the managed money build essentially record short positions. And then in recent weeks, they've been unwinding those positions for the sector as a whole. Kind of popped up, overdid it, come back down a little bit, as you see the little nub right there. But overall, now where do we go from here is going to be the key. And I think what I saw in the week prior to the election is the market's just chopping sideways to see where we're going to go next. And now they're kind of waiting for some direction on policy. And here you see it broke out by sector all together on one graphic. But this is a 1-year performance here, with the black line in the middle being the composite. So over the last 1 year, the composite has grown slightly. What is that, about 4% or so for the commodities as a whole. The big drivers there have been precious metals. As I said, gold at record high prices. What's been the lagger? It's been grain and oilseeds. And all farmers can tell you about how painful that has been. Next has been energy prices that have underperformed over the past year as a whole. If we look at the U.S. ag commodity dynamics, we're seeing that managed money is focused on reinflation risks, and that has helped pull us off of our bottoms. It's yet to be determined whether those reinflation risks are going to turn into reality, and I think that's why they're really not building ownership, so to speak, in most of our ag commodities. Fundamentally, most of the ag commodities are amply supplied. We do have long-term interest rates increasingly reflecting the rise in the supply of U.S. debt certificates because of government spending at a time when we're seeing fewer people now interested in owning those debt certificates. And so that, as we increase the supply of debt certificates and decrease the demand for them, we see an increase in yields. I mentioned about the debt ceiling talks ahead of January 1st. Keep an eye on that. Will there be a credit rating downgrade as a result of those talks? I do think that the Fed may slow or even bring to a halt its current path of shrinking its balance sheet. I kind of expected that they would adjust that pace at the meeting yesterday, and they really didn't do so. So now I'll be looking to the December meeting to see if they do so. Let's talk about Trump re-election implications. Trump 2.0. Tariffs can be expected, especially against China. Now, having said that, Trump was apparently wisely advised during his first term that even though you're going to be hard on them, be kind to Xi Jinping, build a relationship with him. And that was key. That's why he was able to come to an agreement on a trade agreement, because he had a relationship, because the Chinese do business based on relationship. And they may not like your position. They may not agree with your position. You may be hard-nosed with them and they may be hard-nosed with you. But if you have a relationship, you can do business. So we'll see how that plays out in 2.0. Overall, I do think that deleveraging of the West is going to continue to hurt China's economy. I don't think the $1.4 trillion package they have now is going to be enough, although it has provided a bump. It's interesting to see whenever we've got a bump in their stock markets, largely been because of state-backed funds pumping billions into the market. And then at times that momentum will pull in private money. But that ability to do so is starting to wane. Commodities, on the commodity side, I think China is going to continue to move away from dependency on the United States, as I've talked about many times before. I don't think tariffs is going to make much of a difference there. I think that pattern is going to continue regardless. China will buy the commodities it needs. I've seen China in 2012 pay over $20 a bushel delivered for soybeans because they needed them. But the problem is our currency exchange rates are always going to make South American beans cheaper if they're available. So if they're available, China's going to be buying from them, and then the rest, when they're no longer available, they'll buy the rest of what they need from us in the United States. And as Brazil continues to expand its production, that means they have more and more available, and we're seeing a flattening of demand from China. China's going to need fewer from us. So tariffs are not. Now, President-elect, when does he bring in the tariffs? It could be on day one. I doubt it. It'll probably be in the first 100 days. My bias is it'll be closer to the beginning of that 100 days than toward the end. But regardless, even if it's on day one, that's going to be the time anyway when China will have been moving to South America to buy new crop supplies from them. And so they will have already been moving away from dependency in the United States. And so the bigger impact will come next summer when there'll be time for them to start booking soybeans from us for next fall shipment. And so that's what we're going to have to watch. Now, on the liquid biofuels side, I get a lot of questions about it. Is Trump going to support liquid biofuels? I see very little direct change or support for liquid biofuels. I didn't feel like either Vice President Harris or Trump 1.0 were particularly supportive of the liquid biofuels. I don't see that changing. But where we could see a change is I do think that Trump is going to remove government support for pushing us toward adoption of electric vehicles. Not going to block them, but make it more of a free market. That's going to slow that down. And it's been the EV market drive that has been trying to block support for liquid biofuels. So maybe we get less headwinds on the liquid biofuels as a result of that. The other thing I'm going to be watching is, does he put tariffs on used cooking oil coming from China? And we get better than 50% of our used cooking oil coming into this country for green diesel production that comes from China. And so a tariff against it could block that. And it's currently displacing soy oil and canola oil usage. And so that would be expected to increase demand for that. What we really need is the new 45Z requirements, though. And until we get those 45Z requirements that outline the subsidy levels for the various feedstocks and the requirements of the feedstocks to get subsidies, until we have that, we're going to see processors who produce the green diesel start to shut down as we get closer to 2025, and that's going to start backing up soy oil. That's why we're seeing big exports of soy oil now, because it's available. So that and a tighter palm oil situation balance sheet combined is supporting it. And so we'll see how that plays out. Will Trump influence it? He might. I think he's got a full enough agenda. I'm not sure that he will directly influence the 45Z, but the fact that the tariffs could come on used cooking oil coming from China, I think that may be the bigger question right now. And then what does Xi Jinping do relative to a Trump presidency regarding Taiwan? Does he try to take over Taiwan before Trump takes office on January 20th? Does he wait until Trump has left office? Does he do something while Trump is in office? That could ultimately have the greatest implications on commodity trade with China. Geopolitical risk. We come back to China. Economic data there is frankly bleak. The stimulus packages that have been offered have given us a bump now, but can they really sustain that bump? And there's a lot of skepticism about that. I mentioned the 10 trillion yuan package. That's equivalent to $1.4 trillion. The general assessment is it enough? Probably not. So there's speculation that maybe when Trump comes in office, there will be a second package. We'll see. I mentioned already state-backed funds being used to try to create stock market strength, but consumer fears are certainly elevated in China over what a Trump election means and the deleveraging away from Chinese goods there. We've seen also an increase in military incursions near Taiwan. So all still geopolitical risks associated with the China issue. A note of interest here related to the energy question: by year-end, gasoline cars are projected to hold just 54% of China's new car market, down 8 percentage points year on year. However, they will still make up 70% of China's total vehicle fleet by 2030, and that will not drop below 50% until 2040. China's EV market is forecast to displace 248,000 barrels per day of gasoline demand this year and 810,000 barrels per day early next decade. However, an outright gasoline demand will only weaken slowly because of a low replacement efficiency and discrepancies between laboratory fuel economy results in real-world gasoline consumption. If we look at China's home prices falling, which make up a major part of homeowners' average homeowner assets, that is one reason that consumer sentiment is really hurting. We have seen a recent bump in homeowner prices, but they're still below where they were a year ago. Slow escalation of risk continue in the Black Sea. The Trump campaign promised that he would quickly bring an end to the Ukraine war. Sanctions on Russia, though, are still not likely to be reversed. Ending the war would not end Putin's long-term objective. It might simply suspend it while Trump is in office. So I'll be real curious to see how he lives up to this promise of bringing it in. I think it's one reason, as I've talked to you before, that we've seen ahead of the election, Ukraine make an aggressive move into the Kursk region of Russia so that they would have land to trade with land that Russia took from them. Middle East, contrary to what Trump said about Ukraine, he told Israel, finish the job. So we expect to see more support for Israel. Now, I think one of the keys is, does Trump revive the Abraham Accord to further isolate Iran from its Arab nations? This was something that Trump 1.0 was able to accomplish before they left, of assuring these Arab nations who fear Iran that we will support you in the face of Iran if you'll sign this peace agreement, be at peace with Israel. And that has been allowed to really crumble over the last 4 years to a great extent. So the question is, can the Trump administration rebuild that relationship of trust with these other Arab nations? And that may be one of the keys to moving us back toward peace in the Middle East. Sanction enforcement we'll probably see on Iran as well as Venezuela. This drill baby drill policy of Trump, don't expect an immediate increase in output. So that's why I don't necessarily expect oil prices to go down. But at the same time, if oil prices go up, then I do think that freedom will be there to increase, and that confidence will be there to increase production. Right now, oil companies are showing good restraint. They've got the wells they can use. They'll probably have more under Trump administration, but they're only bringing them into production as the market dictates. And I think that's probably wise. Regardless, I do expect us to move back toward the energy independence that we had during the Trump administration. Argentina, I talked to my contacts in Argentina because they've got reform there with President Milei. And they've tried to have reform before, and it just failed. So I reached out to my contacts and said, okay, how's he doing? And they sent me this graphic, which shows monthly inflation. This is monthly inflation. So 4.2% month-to-month basis put out over a year's period of time is still 40-some% interest over a year's point of time. Keep in mind that it's been over 200% inflation. So they are bringing it down. The question is, where do we go from here? Part of that is Milei's ability to stay in power. And so he also sent me this. This is showing his popularity, political popularity in the country relative to other previous leaders. And it is still relatively strong for Argentina. And that suggests that he's going to continue to be effective at bringing about these reforms necessary. Now, let's look at weather risks. One of the things that I did is went back and looked with the help of Eric Snodgrass of Nutrien, looking at and to develop these composite maps. I developed these composite maps for all the years following a weak winter La Nina. That's what we have right now, weak winter La Nina. So if you throw them all together, and there's a neat website where I was able to do this, it shows that the following growing season, May to August, the left side, we tend to be dry in the Midwest and in much of the plains. And the right-hand graphic, we tend to be warm in the western, in fact, outright hot in the northern plains. And that tends to suppress yield as a whole, but not every year. For example, you'll notice in 2009 is in that list of analog years. 2009, we had greenhouse effect, so to speak. We had record corn and soybean yields that year. So it doesn't guarantee that we're going to have crop problems next summer. It just suggests that we have increased risks, and we will continue to monitor those risks. Again, I showed you this graphic last month. And if we look at weak La Nina, we tend to have 55% odds in center west Brazil of having favorable rainfall. If we look at Argentina, only 18% odds of having normal rainfall or a good finish to the growing season. So you can see the strength of La Nina makes a big difference. And overall, Brazil is better set than Argentina. So if we look at rainfall for Brazil's soybean belt since October 1, you see that most areas have been getting good rains. About 10% of the belt is still struggling with dryness. On the right, you see how it compares to other years. Notice that normal rainfall in October is right at a little over 7 inches. So normal is quite a bit of rain for the soybean belt. And this year we're below that, but we're still above 6 inches. Now it doesn't come even, and there are certainly some problem areas you see on the left, but we're not near as dire a situation as we were when we met last month. Now, the soybean crop, therefore, looks good right now. It may even end up above trend yields. We'll have to see how that plays out. It could still turn dry and change all that in December. But what about the winter corn crop? And that would be the 4 to 6 month outlook, April, May, and June. How does it finish? Well, this graphic looks pretty good. You have the European model on the left and the American CFS model on the right. Those are actually pretty good model runs for being able to sustain, have a good crop. Could all this change 6 months out? Absolutely. But right now, the models are looking fairly favorable. Okay, look at the fundamentals of the grain and oilseeds. Well, here is our latest graphic showing our customer survey results. The corn yield came in at 183.7 bushels per acre with the soybean yield at 52.6. Okay, you can see that. You can come back to the on-demand. You can study this graphic. Our corn yield was down about 1/10 of a bushel. Soybean yield was just a little bit more than that. Here's the numbers from today. USDA 183.1 bushels per acre, below us. Our customer survey. Soybeans at 51.7, again, below our customer survey. And if you look at the soybean yield, it was below the lowest of the private estimates. So pretty small. And I really wasn't surprised at that, seeing how the crop finished this year. And here you see state by state the changes in yields relative to what we saw back in October. And here we see the same for soybeans. Pause a little bit to let you study it. You can go back and look at it, as I said. And by the way, if you want to download this presentation, you can go to the resource section here on the platform in front of you, and you can download the PDF and you can study it. Here we see the subjective yield data from the samples they collected. And what it looks like to me as I look at this is we had to get this 1.4 bushel yield drop from October, is it looked like we had a modest drop in pod counts and a drop in seed size. And that's how we ended up with our lower yield, and that would both be related to the dryness. U.S. ending stocks, so the biggest thing that sticks out there, not much change in wheat. Corn drops modestly, but soybeans more significantly, to 470 million bushels. If we look at global stocks, nothing really to speak of just at these face value numbers. And when you break down the corn numbers, USDA made some major adjustments in their country by country balance sheet, but nationally it just dropped to about 2.4 million metric ton for corn. Soybeans saw what is it, about 2.25, 2.3 million metric ton decline, wheat basically unchanged. Here's my balance sheet. The big thing that changed is USDA's yield estimate right here. And this is what our customer survey showed that I showed you earlier. So we're 0.6 bushel per acre larger. And you can see how that plays out in larger production that we had of about 60 million bushels. USDA really didn't make any other significant changes to the corn balance sheet. If we look at managed money, they continue to cover their short positions. They're really struggling right now whether to continue to do that. If we look at soybean yields, dropping from 51.7 to 52.6 this week, just what is that? About just shy of a bushel per acre drop. If we look at managed money, covered most of the short positions, but put a few back on over the last week. If we look at our wheat balance sheet, very little, if anything, changed here. So I'm not going to spend a lot of time on it, but bottom line is we have adequate wheat stocks right now to try to sustain a rally. If we look at where that's at, what's the tightest as we look at this? Well, as you look at it, what's the tightest is going to be some of the specialty wheats, the white wheat, soft red winter wheat, actually, believe it or not, much different scenario than a year ago, and the special fuel oils and gasoline. That's going to be what really drives us going forward. If you start to see Russia back off in exports and restrict, then becomes, okay, where can I get the quality wheat issue? And you see them start to come into the northern plains seeking after some of the higher quality milling wheat. And that starts feeding through the system and impacting the supplies and availabilities then. Total wheat supplies among major exporters is getting snug. We see that overall wheat supplies in the world are pretty big, but over half of those are in China. And so when you look at exportable supplies of milling quality wheat, look at this number right here. It's at a historically low number, close to where we were in 2007. We got a lot of support this fall from the drought in Russia, so I wanted to update you on that. We had quite a few showers in the month of October. A few dry pockets here. So a few dry areas, and even these rains aren't overly wet, but if you add it up for the year, compare this to Brazil, normal rainfall from October 1 to now is about 2 inches of rain. And that's what you have when you average this all together, but that's because we have a large area up here that had 2 to 4 inches in the northern part of the belt. Southern part is where the real problems are at. Soft red winter, funds trending towards smaller positions of managed money. Same thing in Kansas City, hard red winter. So let's kind of summarize things up, and then we'll get to your questions that some of you have been asking in the Q&A box on the right. Overall, our take-home points. The U.S. is well stocked with the primary food-based commodities. There really isn't a reason to ration demand with significantly higher prices where we are right now. In fact, when it comes to corn, to rally prices now would simply encourage more planting of winter corn crop in Brazil, increasing the supply. The wheat market continues to wait for Russia to curtail exports. We believe it's going to have to happen, but when will they do so? Right now, they're still dumping cheap wheat. They've been trying to prop up the price, but not very successful at it. Soybean stocks are in decline after today's report, but notice even though they cut 121 million bushels from the supply, they cut 15 million bushels from crush, largely because of this lack of 445Z requirements or guidelines. And so processors who make the green diesels don't know, are we locking in a profit? Are we locking in a loss since we don't have the guidelines on subsidies? And so I think the crush reduction was appropriate overall for soybeans. When we look at the big South American crop coming, I think that's why USDA cut its soybean ending stocks estimate, but did not raise its marketing year average cash price, because it's anticipating that big supply to hurt exports, and exports were cut by 25 million bushels. Corn stocks are still ample, but they are trending smaller. So let's keep our eyes on that Brazil winter crop, which is still some months away. I think the key focus now is going to be in the near term on the 45Z guideline development, and particularly any particular tariff development and how it might impact used cooking oil demand or imports in the United States. Reinflation concerns are supported by managed money short covering, or they do support it. I'd say the geopolitical risks are changing. Russian war may come to an end. Trump said he's going to end it. On the other hand, he tells Israel, finish the job. How's that going to play out? Do we get the Abraham Accord revived type of thing? All of those are potential tough spots for the commodities, be it opportunities or more bearish prices going forward. So with that, I'm going to close it out. There's how you can reach me on your own. Victoria is going to read some of your questions, and we'll go through as many as we have opportunity to do so. So Victoria, I'll turn it over for you while I grab a drink here, and we'll start with the questions.
Perfect. Thanks, Arlan. The first question we have is, do you see another change on corn and soybeans yields in the next S&D reports?
Yeah, I've totally forgot to answer that question when I was going through the yields. If we look at history, USDA tends to not change its yield forecasts in the December WASDE report. So the focus there is going to be more South America. We'll talk about election implications again and what we've learned by the December report as far as Trump policy directions, et cetera, and cabinet appointments, what impact that might have. But more of the focus is going to be on South American weather. Then come January, USDA will have the results of their December 1 quarterly stock survey. How many bushels of corn, soybeans, wheat, et cetera, were in all positions on December 1, and that will give them greater confidence in their production numbers. And at that point, they will revise their production estimates. So we very well could see another adjustment in January. We could see it ratchet down a little bit more. At this point, I don't see any evidence that it's enough to be a market mover, but maybe we'll know more by then. But yes, I would expect to see some adjustment in January. The question is, will it be enough to be a market implication? So far, the market doesn't think so, because we have such big supplies on hand in the bin, and we have a big crop of soybeans coming from South America.
Okay, the next one is, don't you think that given the USDA has lowered the corn production, they should have lowered the corn use as well, just like they did regarding the demand of soybeans?
I don't think so, because we're seeing a reduction in production in the Black Sea. I think that trend continues this year, shifting away from corn toward oilseeds, soybeans, sunflower, canola, etc. Argentina shifting away from corn, roughly 20% reduction in area planting to corn, a 10% increase in area planted to soybeans. That's a valid question. It's a good question, but I think those are the reasons why USDA didn't cut demand. Frankly, I was surprised they didn't increase export demand for corn. They cut soybean exports by 25 million. I talked about that, because of the big crop coming in South America, but we don't have that same assurance that we'll have that big crop of corn in South America, and so therefore they left that demand there for now.
In a trade war scenario, what would be the hit on soybeans exports, in your opinion, for 2024, 2025, in the worst case?
Yeah. Wish I had $1 for every time I was asked that question by a reporter over the last month, and I don't see it having any notable difference at all. If you look at the trade war problems in 2019, 2020. Keep in mind that China was battling African swine fever at the time. That decimated, according to our boots on the ground, estimated 2/3 of the hog herd gone because of African swine fever. So their overall demand was low. So when we look at market share, US market share fell between 2.5% and 3%. Very small. Less exports, yes, but less to South America as well. And overall market share, just 2.5% to 3% difference. And China will continue to buy all they can from South America, and the rest of what they need, they'll buy from us. They'll pay whatever price is necessary to make sure they have it. I think the bigger question is, do they make a move on Taiwan? And if so, we'll probably have sanctions that make it difficult for them to buy. And I think that's the greater risk right now.
Do you think the corn exports are all front-loaded and the pace will change when the new administration takes over? USDA left exports unchanged this month, but pace is fast currently.
That's possible, but when you look at the pace, Mexico's been the big driver. So when you look at the pace, and I should have included a graphic on that, and forgot to do so. When you look at the pace of Mexico's buying this year versus last year, it's only ratcheted up a small bit, not much. Now, last year was a big jump over the previous years, but last year to this year is not much change. It is possible they are doing so because we have seen a big drop in the peso after the Trump election. And so a lot of buyers may have been trying to front load, anticipating a drop in the peso, trying to use their buying power of the stronger peso prior to the election to do so. So we'll watch the continued buying pattern there. I think the currency exchange rate needs to get more credit than anything else right now. And the fear that we would see exactly what we saw, a big drop in the currency exchange rate value of the peso versus the dollar.
Okay, next one is, considering the South American soybean crop coming, is there a calendar spread you would put in your watch list?
Boy, I have to be very careful as I talk about that because of the regulators and what I'm allowed to say. The way we've structured our department, our brokers have a lot more freedom in that area. But I think the key, as always, is going to continue to be that old crop U.S. price, be it July, and new crop. I'm sorry, let me back up. I was thinking U.S. growing season. I think we need to keep in mind and watch that March futures contract, because that's what the South American farmer is going to be selling against. Also monitor the July, because see if we can get premium for the carry in the market, and then relative to the November, which will be looking ahead to U.S. production for next year. Specific spreads and actions, I can't tell you due to those regulatory, but those are areas I want to keep in mind, because that's what the funds and other traders are going to be trading based on what they see in South America and then in next growing season here in the Midwest.
Will there be change in 45 under Trump?
45Z under Trump, it is very difficult to tell right now. I don't see him as any bigger supporter of liquid biofuels based on what we saw in 1.0 than what we saw the last administration. He might speed up and get it out, which would be a boost to just get it out so we know what the rules are going forward, and that might happen. But I think he's got such a full agenda and other items, I'm not sure that'll be a priority. I think the bigger item is going to be whether he does something to block all that used cooking oil coming from China.
There was attention brought to the U.S. corn export forecast prior to today's waste release, with some thinking that was going to draw ending stocks down instead of yield. What are your thoughts? Do you think the recent sales pace was a flash in the pan, or can it be sustained until Brazil reloads with safrinha? Accumulated sales are getting rather close to 2021.
Yeah, I think we're going to have to watch the safrinha crop closely, but overall, I anticipated a stronger export sales pace. And so I've had a higher export target than has USDA. And I anticipate USDA is going to have to continue to expand it. The question is how much, and will it draw our ending stocks close enough to that 1.5 billion level to justify higher prices? I think we're moving in the right direction overall, but it's really going to depend. I did indicate that I felt like some of the buying by Mexico might be based on fears of the peso. And if that's the case, then over the next few weeks, we should see a dramatic decline in Mexico purchases. If we don't see a dramatic decline over the next few weeks, then I think that's a good sign that the demand overall is sustainable for export sales.
What is the most likely trading range for U.S. soybean oil next year? Do you expect very different trading ranges depending on U.S. tariff policy? If so, what are the resulting ranges?
As I said before, I cannot speak on trading objectives for derivatives the way my department is structured. Our brokers can, but I cannot. But what I would say this is I do expect soybean oil prices to be driven largely by when and if we see tariffs on Chinese used cooking oil coming to the United States. I think that will have the biggest impact.
Okay, I'll split the next one into two questions. First one, how are the prospects for the farmer break-even for the new season for corn and soybeans North American farmers?
Right now we're below break even, but the farmer can still, in most cases, return enough for it to pay his variable costs. And so as long as he can sell his grain for enough to cover his variable costs, he may be at a loss in total cost, but he's still going to plant. And the farmer always has optimism, so he always thinks prices will get better before he harvests the next crop. So I do expect soybeans to struggle in the months ahead. I do expect a modest shift in corn acres, with the core of the Midwest keeping their rotations, but around the fringes, I think we adjust things. And I think corn may lose 1.5 million acres, maybe up to 2 million acres. I'm sorry, gain 1.5 to 2 million acres at the expense of soybeans, depending on how things play out with the soybean market as we get deeper into the South American growing season. Now, question number two.
How do you see the growth in crushing capacity in USA and Brazil and the impact on soy meal world S&D dynamics in the next 3 years?
We do still project some more soybean crush capacity coming online, and I think the loss of export business to China is going to help continue to push that. The push toward liquid biofuels is going to continue to support that. That has slowed down somewhat because some of the problems I indicated, but I do see us still doing some increasing, and that is going to increase the supply of soy meal, and that's going to be good for livestock producers. I think we're going to see soy meal exports like this last week that were very strong. I think we're going to see more of those weeks of strong exports of soy meal, but that's something that's particularly been of interest from our competitors down in Brazil.
That was the last one, Arlan.
All right. Thank you, Victoria, very much. I appreciate it. Look forward to seeing you all again in December when we have our next webinar following the USDA crop report. And as I indicated, we'll be able to spend more time then looking at what we've learned about what the Trump administration will look like and what implications that might have for the commodities. And we'll be looking deeper at the weather for South America and for their growing season. So until then, be careful and look forward to seeing you all back come December. Thank you.